They said the market would never crash. They whispered about new eras, perpetual upward cycles. Then came a single day, then two. Then the floor gave way. On October 29, 1929, the world watched as fortunes evaporated, billions wiped out, and an era ended. This wasn't just a market collapse. It was a turning point, a rupture in faith, in prosperity, in belief itself. But the chaos we remember, the panic, the screams, the ruin, it was the climax, not the beginning. Before that fateful day, something had been building. Layers of debt, hubris, fragile structures, and quiet missteps. In the next chapters, we'll rewind time. We'll trace every tremor that led to the quake. We'll expose how a golden age soured and why today's world still echoes its lessons. If you want to truly grasp how markets unravel, how confidence dies, stay with me. Hit subscribe, ring the bell, and let's walk that perilous path from boom to bust together. The Roaring Twenties, when everything seemed possible. Imagine Manhattan in the 1920s, neon lights flickering over Broadway, cars, radios, electric kitchens, skyscrapers climbing the sky. Everybody believed the future was theirs. The war was over, industry was surging, innovations were multiplying, mass production, assembly lines, chemical fertilizers, automobiles. The very fabric of daily life was changing, and in the background money whispered, invest, grow, multiply. For many Americans, the stock market became a temple of hope. Blue chips, industrials, utilities, they weren't just companies, they were promises. You could borrow, you could speculate. People who had never held stocks before now trusted their life savings to brokers. The mania was contagious. Between 1921 and 1929, the Dow Jones Index rose nearly sixfold, from about 63 to 381.17. That rise was breathtaking. Too breathtaking, many would say later. It fueled more optimism. It pulled more people in. It hid the tension beneath. But underneath the dazzle, structural cracks deepened. Hidden dangers and structural faults. What nobody wanted to see, the foundation was soft. Here are the hidden dangers: margin and leverage. One of the most dangerous tools of that era was margin buying, using borrowed money to buy stocks. You might put down 10, 20, or 30% and borrow the rest from your broker, with the stocks themselves as collateral. If prices rose, your returns multiplied. If they fell, you owed more than your stake. By 1928 to 1929, margin loans had ballooned. Some estimates say brokers' loans approached $6+ billion, more than the entire money supply. That meant an enormous amount of risk was built on borrowed faith. Holding companies and investment trusts. To amplify returns, many speculators used holding companies, layered structures that held stocks via debt, masked by complexity. They masked leverage, obscured risk, and magnified failure when things turned. Overproduction and weak consumer demand. Factories produced more than people could buy. Farmers faced falling prices and crushing debt. Wealth was skewed. Many Americans lived close to the edge, dependent on credit or borrowed funds themselves. Bank exposure. Banks too were exposed. They often lent to speculators or held stock themselves. When the market turned, their balance sheets cracked. Monetary policy, tightening. The Federal Reserve, worried about speculation, began to tighten credit. Interest rates rose. Loans became costlier to service. That extra pressure on borrowers, individuals, firms, banks, amplified the fragility. Faith in perpetual growth. Most investors, economists, and leaders believed the upward trend was unstoppable. Irving Fisher, arguably America's leading economist, exclaimed that stock prices had reached a permanently high plateau. That belief, held widely, blinded many to risk. So the stage was set. Excessive credit, hidden leverage, unequal prosperity, rising rates. It took just a trigger. Cracks appear, the prelude to panic. As 1929 unfolded, little tremors appeared. Warnings whispered, but few heeded them. On September 3, 1929, The Dow peaked at 381.17. After that, subtle declines began. Prices wobbled. In private, some analysts and insiders worried. In public, the bullish narrative held firm. By October 8th, Charles Mitchell publicly said nothing could stop the upward movement. By October 16th, Irving Fisher voiced confidence in that permanent plateau. But confidence is fragile. On October 19th, heavy trading and unease gathered. Then October 21st to 23rd passed with mounting tension. Margin calls, nervousness, weakening bids. And then came October 24th, known forever as Black Thursday. Black Thursday, October 24th, 1929. The first blow. Thursday dawned. The market opened 11% lower than the prior close. Panic spread. Nearly 13 million shares traded, shattering previous records. Phones rang off the hook. Ticker machines lagged behind. Confusion reigned. Traders and bankers scrambled. Some of the nation's leading bankers intervened, placing large buy orders to steady the market. Richard Whitney of the New York Stock Exchange made dramatic bids. Miraculously, by closing bell, losses had narrowed. The Dow was down, but not erased. Hope flickered again. But that recovery was fragile, temporary. Black Monday and Black Tuesday, the collapse deepens. Then came October 28th, Black Monday. The Dow fell approximately 12.8% in a single session. The next day, October 29th, Black Tuesday, the plunge worsened. More than 16 million shares traded in a single day. The Dow lost approximately 11.7%. Over 2 days, approximately 23% of market value vanished. Tickers lagged hours behind. Phones and telegraphs jammed. Desperate sellers swamped brokers. Margin calls shredded accounts. Men who had bet everything on upside found themselves wiped out. By mid-November, the Dow had lost nearly half its value. The collapse would continue. By July 1932, the Dow would reach 41.22, an 89% drop from its peak. Some call that the low point of despair. $1 invested at the peak would be worth barely a dime. Aftershocks, the broader impact. The crash was not the end. It was the beginning of a deeper decay. Businesses shuttered. Factories slid into silence. Unemployment exploded, nearing 25% at its worst. Banks failed. Life savings evaporated. Foreclosures, hunger, despair became everyday realities. Shantytowns, Hoovervilles, dotted city outskirts. Faith in institutions crumbled. Yet even then, optimism lingered. Some leaders insisted recovery was near. Some believed the crash was a temporary lurch, a correction. But the deeper rot of credit contraction, deflation, policy missteps, bank panics, and collapsing demand would drag the US and global economies down for years. The roots beneath the boom. We often think of crashes as sudden, a bolt from the blue. But the crash of 1929 was decades in the making. To understand why the collapse wasn't just about a bad day, we must excavate the roots. The 1920s boom was real. Productivity soared. Industrial output surged. Innovations reshaped life. But economic growth wasn't evenly distributed. The wealth was concentrated. Credit became the universal lubricant. Debt crept into every corner. Farmers, consumers, corporations, banks. Agriculture was already in crisis. Farm prices had been declining since World War I. Farmers borrowed to plant, to survive, but their incomes shrank. They were squeezed from both ends. Industry, meanwhile, produced more than could be consumed. Factories churned out radios, cars, appliances, but demand couldn't keep pace. Unsold inventories piled up. Some companies slowed. Others overextended themselves. Consumer credit, installment plans, mortgages, margin accounts made it seem like prosperity was permanent. People bought what they couldn't afford, betting future income would bridge the gap. That illusion made houses, cars, stocks seem cheap. On top of all that, the financial system began to strain under its own weight. Leverage, credit, and the mirage of safety. One of the most dangerous illusions of the 1920s was the belief that leverage was safe, that credit would always carry you upward. But credit is a two-edged sword: margin and speculative debt. As discussed earlier, margin buying magnified returns on the way up and losses on the way down. When investors used borrowed money to chase every rally, the downside became catastrophic. Holding and investment trusts. Compounding the danger were holding companies and investment trusts. Complex layers of ownership, debt, cross-guarantees. They obscured risks. They boosted apparent gains, but they also multiplied exposure. If one layer cracked, many others would collapse in a chain reaction. Banks and interconnected exposure. Banks, in turn, were not remote observers. Many had lent to speculators. Many held stock or shares in trusts. Some were part of holding structures. When the market turned, banks' assets became distressed or worthless. Gold and international capital flows. Internationally, money flowed into U.S. markets. Gold moved toward America. Credit eased globally. Foreign capital fed the boom. That made the U.S. sensitive to global shifts, capital withdrawals, and monetary adjustments. Monetary policy and interest rates. Worried about overheating speculation, the Federal Reserve tightened credit in 1928 to 1929. They raised discount rates, made loans more costly. That squeeze hit leveraged investors hardest. The cost of borrowing climbed just as markets began to tremble. These layers of debt, interconnection, and policy tension made the system brittle. Psychology, confidence, and the herd. Markets are not just numbers. They feel things. They breathe risk, greed, fear. And in 1929, the psychology turned. Confidence as currency. In a bubble, belief is the foundation. Investors trusted that prices would always rise. They dismissed skeptics. They treated the bubble as baseline reality. Narrative of new era. Many believe the 1920s heralded a new economic era, one of perpetual prosperity, immune from past cycles. This narrative silenced caution. It made risk seem quaint, outmoded, groupthink and social hype. As stock ownership spread, stories of wins abounded. Neighbors, co-workers, relatives talked of easy gains. It created pressure. Get in now or miss out. Blind spots and overconfidence. Even economists, bankers, and policymakers got swept up. Irving Fisher, a leading economist, famously declared that stock prices had reached a permanently high plateau. That statement, in hindsight, reads like a tragicomic misstep, but at the time, it echoed the dominant faith. When conditions finally shifted, panic spread. The same social dynamics that fueled the bubble accelerated its collapse. The immediate triggers. So if everything was fragile, what lit the fuse? What triggered the downward spiral? Tightening credit and rising rates. As the Fed tightened, borrowing became costlier. Speculators felt squeezed. Some began selling preemptively. Profit-taking and early declines. In September 1929, markets peaked. The Dow hit 381.17 on September 3, 1929. Soon after, small declines began. Some traders exited. Some trusts started selling assets. The first cracks appeared. Warnings and sentiment shift. October's early days saw warnings from some analysts. Charles E. Mitchell publicly maintained optimism. Nothing can arrest the upward movement. But in corners, traders grew uneasy. Margin calls and forced selling. As prices dipped, margin accounts strained. Brokers demanded more collateral. Investors unable to meet calls were forced to sell, even at losses. That selling pressure fed deeper declines. Liquidity and sales cascade. As more sellers emerged, buyers retreated. Liquidity vanished. Assets had no ready bidders. Prices collapsed further. A self-reinforcing loop. Bankers' intervention attempt. On Black Thursday, October 24th, a group of bankers led by Thomas Lamont, Albert Wiggin, and Charles Mitchell agreed to support the market. They sent a signal: we will buy. Richard Whitney made dramatic bids. Their bid temporarily stabilized things, but it wasn't enough to arrest the broader panic. These triggers, rate pressure, forced sells, liquidity breakdown, turned the fragile into the fatal. The collapse unfolds. Having peeled back the layers, we now arrive at the moment of rupture. Black Thursday, October 24th, 1929. The day opened 11% lower than the prior close. A record 12.9 million shares traded. Panic reigned. Buy orders from bankers and big institutions helped the Dow recover somewhat. The day ended down a modest amount. That brief reprieve gave false hope. Black Monday, October 28th. The slide resumed. The Dow plunged approximately 12.8% that day. Margin calls mounted. No safe havens remained. Black Tuesday, October 29th. The destruction continued. Over 16 million shares exchanged hands. The Dow dropped approximately 11.7%. Across the 2 days, the index fell approximately 23%. Markets froze. Tickers lagged behind by hours. Investors watched blank screens. Despair set in. Aftershocks and bear market. A small rally occurred on October 30th. The Dow gained approximately 12.3%, but it was short-lived. By November 13th, the Dow had plunged to approximately 198.60, nearly a 50% drop from peak. The crash deepened, and by July 8th, 1932, the Dow bottomed at 41.22, an 89% drop from the 1929 high. Recovery would wait a long, long time. Why this market crash was different. Key lessons. So what made this crash so devastating beyond the numbers? Systemic fragility. This wasn't a failure of one company. It was structural. Debt, interconnectedness, opacity. These traits spread collapse fast. Lack of regulation and oversight. At the time, financial markets were lightly regulated. Minimal disclosure, no central oversight. Insider deals, shady trusts, speculation ran unchecked. No safety nets. There was no deposit insurance. There was no aggressive central bank to backstop failures. When panic struck, many banks couldn't survive. Deflationary spirals. When prices fell, debt burdens rose in real terms. Consumers cut spending. Investments dried up. Deflation reinforced decline. Psychology and confidence loss. Once belief died, so did liquidity. Fear spreads faster than logic. In 1929, that emotional break was catastrophic. Delayed policy response. Initial responses were hesitant, fragmented, and inadequate. Time slipped away. By the time heavier intervention arrived, the damage was deep. These lessons echo across time, into 2008, 2020, and beyond. Aftershocks, collapse, despair, and resistance. The day after, panic becomes reality. When the market collapsed, the damage ran deeper than mere numbers. On October 30th, 1929, the day after Black Tuesday, something subtle but fatal happened. Panic spread beyond Wall Street. People rushed to banks. They tried to pull their money out, but banks had lent depositors funds into speculative ventures. Those funds were gone. Bank runs began. Small banks collapsed. The public lost faith in financial institutions. What had been distant losses on ticker tapes became personal despair. Within months and then weeks, the fallout accelerated. Credit froze. Businesses could not get loans. Factories shuttered. Unemployment mounted. Banking system breakdown. The U.S. banking system was dangerously exposed. Here's how the breakdown unfolded. Banks invested in what they shouldn't have. Many smaller banks had made speculative investments, holding stocks, owning shares in trusts, or lending to speculators themselves. When those assets devalued, banks' capital crumbled. Thousands of banks failed. Reserve requirements and liquidity constraints. Banks could not fulfill withdrawal requests because they lacked liquid reserves. Interbank credit denuded. Many institutions had no safety valve. Regional panic and contagion. Failures in one area sparked fear elsewhere. Depositors in distant towns, hearing news of collapses, ran to their banks too. The contagion was real. Banking crises emerged in waves, 1930 through 1931. Federal Reserve hesitation. The Fed did not act decisively. Some branches favored supporting New York. Others balked at extending credit to weak banks. By the time serious steps were taken, much damage was already done. Credit contraction and deflationary spiral. As banks failed and credit contracted, prices fell. Falling prices made debts heavier in real terms. Consumers delayed purchases. Businesses cut investment. Deflation fed recession. This was no mere shock. It was systemic collapse. The human toll, lives torn apart. Numbers tell part of the story. Emotion tells the rest. Unemployment and poverty. By 1933, nearly 25% of America's workforce was unemployed. Wages for those who kept jobs dropped, often by 40% or more. Families lost homes, farms, dignity. Shantytowns and Hoovervilles in city margins, shelters sprang up. Cardboard, scrap wood, tin, anything to build a roof. People called them Hoovervilles, blaming President Hoover for the crisis. Migration and despair. Farmers, especially in the rural South and Dust Bowl regions, faced ruin. Many packed up and headed west, toward California, toward hope, toward heartbreak. Communities splintered. Children went hungry. Families separated. Suicide rates rose. The spirit of a generation was battered. Psychological trauma. For millions, the crash shattered faith in American promise. The belief that work, effort, savings would protect you. That myth cracked under the weight of collapse. Loss was everywhere, financially, socially, emotionally. Government response and policy failures. In crisis, governments act, but actions take time. Misfires happen. Ideology constrains. Here's how the response unfolded, and often failed. Hoover's philosophy. President Herbert Hoover believed in limited government and self-reliance. He feared overreach, so early responses were cautious. He asked businesses not to lay off workers. He asked banks to maintain loans. He asked Congress for modest public works. But confidence kept slipping. Tariffs and trade contraction. In 1930, Congress passed the Smoot-Hawley Tariff Act, raising trade barriers. Other countries retaliated. Global trade collapsed, especially harmful for export-heavy U.S. regions. Monetary policy missteps. Rather than expanding the money supply, the Fed often tightened or held back, fearing inflation or gold outflows. They failed to act as a lender of last resort in many cases. Regulatory vacuum. There was no deposit insurance. Banks could gamble freely with depositors' money. Securities markets had minimal oversight. When abuses were exposed, reform came, but too late for millions. Pecora Commission and reform. By 1932, Congress launched the Pecora investigation, exposing financial abuses. Wikipedia. This laid groundwork for sweeping reforms. Glass-Steagall, SEC, regulations separating commercial and investment banking. The policies of the 1930s would reshape America's financial architecture, but the question remains, were they too late to prevent disaster? Global echoes, depression spreads. The crash wasn't isolated to the US. It echoed, magnified across continents. Gold standard rigidity. Many nations remained tied to the gold standard. They could not adjust monetary policy flexibly. When capital flight hit, they were forced to deflate. Credit withdrawal and debt defaults abroad. European countries, many indebted after World War I, had borrowed heavily from the US. When US banks pulled back, they cut credit lines. Debtors defaulted. The global dominoes started falling. Trade collapse and protectionism. As trade contracted, export-dependent economies collapsed. Countries raised tariffs, closed borders, retreated inward. The global depression deepened. In this way, the US crisis became a global calamity. Not because Americans crashed a market, but because the architecture of international finance bound all together. Could it have been prevented? Lessons in what-ifs. Here's the critical question. Was the crash and collapse avoidable, or was it inevitable, given how fragile the system had become? Earlier regulation and oversight. Had banking oversight, disclosure requirements, and limits on leverage been stronger, speculative excess might have been tempered. Aggressive Fed and lender of last resort policy. If the Fed had acted more boldly, providing liquidity, backstopping banks, the cascade might have been softened. Fiscal stimulus. If the federal government had responded with immediate, bold spending, decline might have been arrested. Avoidance of protectionism. If trade wars hadn't been unleashed, export markets might have buffered domestic decline. But the weight of psychology. Once confidence shattered, policies struggled to keep up. Human fear, herd panic, loss of faith. These are powerful, volatile forces. Even the best response might have minimized harm, not prevented collapse entirely. We'll return to these lessons in the final segment, and especially how they echo today. Recovery, reboot, and echoes. Descent into the abyss, a hard road back. The crash was only the first blow. What followed was an agonizing descent, a decade of struggle, uncertainty, and trial. Between 1929 and 1933, the U.S. economy shrank dramatically. According to historians, U.S. GDP contracted by more than 36% in those years. By 1933, nearly 25% of the American workforce was unemployed. FDR library. Wages plummeted. Factories stood idle. Credit froze. In many places, life ground slow, hollow, painful. Banks failed in waves. By the early 1930s, thousands of banks closed their doors or were declared insolvent. When depositors attempted to withdraw funds, there was nothing left to pay. Life savings vanished. The collapse was not uniform. It struck harder in industrial regions, in rural areas, in places dependent on agriculture and export. Farmers had been under strain even before the crash. Overproduction had driven prices down throughout the 1920s. Many had borrowed heavily to survive. When incomes fell, debt became a burden too heavy to shoulder. Social unrest grew. Homelessness, hunger, migration. These became daily realities. Hoovervilles, shantytowns, sprouted outside cities. Disillusionment spread like wildfire. Even as the darkness deepened, voices in Washington, in state capitals, in America's towns began to question, what must be done? What can one do? Enter Roosevelt and the New Deal. In 1932, voters overwhelmingly rejected Herbert Hoover. They turned to Franklin D. Roosevelt, promising a New Deal for the American people. Roosevelt assumed office in March 1933. He launched a flurry of activity, bold, experimental, hopeful. His policies weren't perfect. They were, however, urgent, creative, and driven by necessity. Key pillars of the New Deal included banking reform and stabilization. Emergency Banking Act, 1933, allowed the government to inspect, reopen, or close banks, restoring confidence. The Glass-Steagall Act separated commercial and investment banking to reduce speculative risk. Through these measures, Congress sought to prevent future bank runs and misuse of depositor funds. Regulation of securities markets. The Securities Act of 1933 required companies to register securities and publish truthful financial statements. The Securities Exchange Act of 1934 created the SEC, Securities and Exchange Commission, which regulated stock exchanges and trading practices. These reforms aimed to bring transparency, fairness, and oversight where speculation had thrived unchecked. Fiscal stimulus and public works. The government launched massive public works programs, building roads, bridges, dams, schools, and more. Agencies like the Works Progress Administration, WPA, employed millions in construction, arts, and infrastructure. The Civilian Conservation Corps, CCC, put young men to work on environmental and land projects. Social safety nets. The Social Security Act, 1935, created unemployment insurance and old age pensions. New protections gave Americans hope that the system would not leave them utterly alone. These were not silver bullets. Recovery took years. Progress was uneven, but over time, confidence began to return. Market revival and long road to recovery. While recovery was slow, over time the stock market began to stir. From its nadir on July 8, 1932, when the Dow Jones hit 41.22, roughly 89% below its 1929 peak, the index began to inch upward. By late 1930 and early 1931, temporary rallies provided glimpses of hope, though some were false dawns. The Dow would not return to its 1929 high, 381.17, until November 23, 1954, 25 years later. Thus, for a generation of investors and Americans, the crash did not feel like a crisis to be solved in months. It felt like a generational shift. Confidence rebuilt slowly, influenced not just by policy, but by memory, by culture, and by the collective will to push forward. Echoes and lessons for today. The crash of 1929 and its aftermath left lasting legacies. Many reforms, practices, and lessons from that era still color markets today. Stronger financial regulation. The SEC, Deposit Insurance FDIC, stricter capital requirements. Many features of modern financial regulation were born out of the crisis. Respect for leverage and risk. Margin rules, stress testing, risk management tools. The idea that leverage can cut both ways became part of market consciousness. Lender of last resort and central bank activism. Fed policy shifted in decades after, an understanding that in crisis, central banks must act decisively. The dangers of inaction became textbook lessons. Social safety nets and fiscal policy. The New Deal's social programs redefined government responsibility. Unemployment insurance, social welfare, stimulus, tools still used today in downturns. Behavioral and psychological dynamics. Bubbles, panics, herd behavior. 1929 remains a warning that markets are emotional, not purely rational. Global interconnectedness. The contagion from US markets to Europe and beyond showed how fragile international linkages can become in crisis. But perhaps the most potent lesson, crisis often reveals the cracks we ignored. Systems seem sturdy until they break. What looks like stability may mask fragility. The memory of 1929 is never just history, it's admonition. Let us return for a moment to Black Tuesday, October 29th, 1929, the day the market snapped. Over 16.4 million shares changed hands. Millions of orders, billions of dollars. The ticker machines couldn't keep pace. In those final hours, the world of late 1920s America collapsed inward. Trusts failed, margin calls exploded, brokerages shuttered, lives shattered. From that moment to the bottom in 1932, the Dow would lose approximately 89% of its value. Recovery, for many, did not feel like redemption, but survival. Tonight, as you look at markets, as you see exuberance, as you hear assurances that this time is different, remember 1929. That crash was not just a relic. It was a lesson in hubris, a warning in prosperity, a reminder that markets rise and sometimes fall with terrible speed. Thank you for staying with me on this journey, from the height of hope in the roaring 20s, through the shock of collapse, through the darkness of depression, to the hard climb back. If there's one message I hope you carry, it is this. Markets never forget. They do not reward arrogance. They respect discipline, humility, and vigilance. What seems stable can be fragile. What seems permanent can vanish. If you found value in this exploration, if these stories sharpen your insight, deepen your caution, stir your curiosity, please subscribe, turn on notifications, and share this video with others who want to understand not just what happened, but why it mattered. In future episodes, we'll examine more crashes, 1987, 2008, 2020, and explore how 1929's echoes still shape our financial world. Join me. Stay curious. Stay observant.